Alright, now let's have a look at the hammer. The hammer is a single candle bullish pattern. So a bullish pattern is where the market is either likely to go up or remain neutral. If you read Steve Nissen's book, Japanese Candlesticks Charting Techniques, in that book he mentions that a reversal is something which tells you that the market, the previous trend is either likely to end or completely reverse. A reversal does not necessarily mean that the market is going to go from up to down immediately or down to up immediately. The reversal pattern is simply a pattern which says that the prior trend is likely to end. Okay? So a hammer is a bullish pattern. It's a single candle pattern. Okay? It's a single candle bullish pattern. The lower shadow must be at least twice the height of the real body. So in this case, the lower shadow of the hammer, so this height must be at least twice the height of this real body. Okay? If it is more, better. It must come after a downtrend, so this arrow mark indicates that the price is coming down, and preferably should have no or very small upper shadow. This upper shadow that you see, if the lesser the upper shadow, the better, because the upper shadow represents bearishness and the lower shadow represents bullishness in the market. So since this is a bullish pattern, we need more of the lower shadow than the upper shadow. Okay? And the lower shadow must be at least twice the height of the real body. The color of the real body does not matter. So the real body should appear at the upper end of the trading range. So if this real body is here, it's not a hammer. And it can be of any color. It can be white or red color, does not matter as long as it is near the upper end of the trading range. Now the real body must be as small as possible. The smaller the real body, the better, because the smaller the real body, the longer will be the lower shadow, and it will be easily more than twice the height of the real body. So it's a single candle. It's a very simple pattern to understand, nothing complicated about this. Okay? So to quickly summarize, a hammer is a single candle bullish pattern where the lower shadow is more than twice the height of the real body. It must come after a downtrend. The body must be near the upper end of the trading range. And lesser the lower upper shadow, the better. Longer the lower shadow, the better. Okay? And generally, the low of the hammer becomes support, because this is where the bears are sitting. This is where the bulls are sitting. And they're trying to push the price up. Okay? So let's look at an example of the hammer. So this is a chart of Asian Paints. It's a daily time frame. The market is coming down, pointed by this blue arrow. And suddenly you have the hammer. So the market has been coming down from first week of November till about third week of December. Okay? There has been a nice downtrend. So we know that the hammer comes after a downtrend. So it's a hammer because the lower shadow is more than twice the height of the real body. The upper shadow is small. The body is coming near the upper end of the trading range, and the pattern is coming after a downtrend. So if I were to take a trade here, I would go long here. I would keep my stop loss just under the low of the hammer, and I would aim for the price to go up. Remember, candlesticks do not give price targets. So for that you need to combine candlesticks with Western indicators. So that's the risk. And we expect the price to go up, which is what happened in this case. Okay? So very simple pattern. One candle can give you an indication of where the market is likely to go over the next few days. This is a daily time frame. Okay? So this day, one candle told us where the market is likely to be headed in the future. Okay? Alright, now let's have a look at the different types of hammers. Remember the conditions of a hammer where it should have a small real body appearing near the upper end of the trading range. The lower shadow must be at least twice the height of the real body, and it must come after a downtrend. That's the basic criteria of a hammer. So if we use that criteria, we get different kinds of hammers here. Now, the difference between this hammer and this hammer is, this hammer has a little bit of upper shadow, which indicates slight bearishness. Remember, the lower shadow indicates bullishness and the upper shadow indicates bearishness. The reason why the hammer is a bullish pattern is because of the long lower shadow. The bulls have pushed the price from the low of the hammer up until this point, the opening in this case, the closing in this case, okay? So, if we compare these two hammers, one is having a bearish shadow, upper shadow, and one is not having any upper shadow. So which ones do you think is more bullish? Of course, this one is going to be more bullish than this one because it doesn't have an upper shadow, okay? Similarly, you can have different kinds of hammers because we said that the real body, the color of the real body of the hammer does not matter. So all of these are hammers, okay? Between these two, this one would be more bullish because it doesn't have an upper shadow. Similarly, we also said that the real body should be as small as possible because if the real body is small, the height will be small. And the lower shadow will be at least twice the height of the real body. In this case, it is multiple times the height of the real body. So smaller the real body, the better it is. So even these 4 candles are also hammers because all of them satisfy all the conditions for being a hammer. Of course, all of this must come after a downtrend. One thing to mention here is that even if the downtrend is a small downtrend, that is still fine. But it should come after a downtrend. If there is an uptrend, and then you see something like a hammer here, okay? That is not a hammer. It is not called as a hammer. Okay, although it looks like a hammer, it is not called as a hammer. Another note to mention here is the reason why it is called as a hammer is because it looks like a hammer. So the Japanese, they call this a hammer pattern. Okay, so let's have a look at an example of a hammer. We mentioned that the low of the hammer becomes a support area because this is where the bulls were sitting and they pushed the price up from here. So that becomes our support, and if we were to take a long position here, we will keep our stop loss down here. Now here is a nice short-term downtrend. It's a daily chart of Bosch daily time frame. It's an example of a hammer. So we are looking at this example, this particular candle we can see here. Okay, so it's a nice hammer. Although the body is black, it doesn't matter, but it looks like a hammer. It is coming after a downtrend. The height of the lower shadow is more than twice the height of the real body. So we can take a long position here, keep our stop loss here, and look for the price to go up. Preferably reach this point because this is where the bears are sitting. We know that the bulls are sitting here, but this is where the bears are sitting because this is where the price turned. So probably there was a trend and then the price turned from here. So that can be our target. So this is our target. This is our stop loss risk. So it's a nice reward to risk trade that can be taken. See, it has reached that target. So this was R1 or resistance 1. This was our support area. The purple dotted line is our support area. So single candle gives us an indication of what is going to happen next. So the hammer is a very important pattern to understand. There are different kinds of hammers. For example, this is also a hammer, which is confirming the support area created by this hammer because this hammer has not been able to close below this support line, which is created by the hammer. So this candle can also be termed as a hammer because it satisfies all the conditions. This is not a hammer because of the small lower shadow. Okay. Alright, now let's have a look at the difference between a normal and a classic hammer. Okay, so what is a normal hammer and what is a classic hammer? So these are normal hammers because it has upper shadow, a small upper shadow. These are classic hammers because they do not have an upper shadow. Okay. Now the difference between the normal and classic is just the extra bullishness that these two candles are displaying by not showing the upper shadow. Because let's say the market has opened here during the session, the market has gone down, it came back up, the bulls pushed the price back up and closed it above to not have any upper shadow. So this indicates bullishness. In this case, the market opened here, maybe went down, then came back up. Then the bears were successful in pushing the price down to close here. So there is a little bit of bearishness here because of the shadow, but there is no bearishness that you see here. It's all bullishness. This candle, there is some bearishness because it's a black real body. However, since there is no upper shadow, this pattern is still powerful than this pattern if we compare the two. Okay, so when the hammer does not have any upper shadow, we would call it as a classic hammer. And within these two, I would like this one because the hammer itself is a bullish pattern. And if you ask me to choose between the black color and the white color, I would definitely go for the bullish candle, the bull candle, the white color candle. Okay, so let's have a look at a quick example of a hammer again. This is a classic hammer because it does not have any upper shadow. Okay, it is coming after this is coming after a downtrend. Remember when I was defining a hammer, I mentioned that even if the trend is a short-term trend, it is still okay. Because hammer, it's okay for a hammer to have a short-term downtrend. If it's a long-term downtrend, it is even better. Okay. So you have a hammer here, a classic hammer. We put our entry here. Stop loss will be under the low of the hammer. And we aim for the price to go up. Now notice some caution here that there is some resistance here. So chances are the price may stall here. So this would be our expected reward. This would be our risk. Okay. So in this case, it has broken this resistance area and it has gone up again, a single pattern forecasting this price rise in the market. Okay. Alright, now let's have a look at the psychology behind the hammer pattern. Why does this hammer pattern is called as the bullish pattern? So let's look at how the hammer pattern is created to understand what is happening behind this pattern. So the day opens here. Assume this is a daily candle. So the day opens here. Then the bears try to push the price down. They take it to the low level. But before the day ends, the bulls come back into the market and push the price not only to the open, but also close it above and close it here. But during the day, they have also gone up and the bears have pushed the price down. So in this case, we have a small upper shadow and a large lower shadow, which is at least twice the height of the real body. So the large lower shadow represents bullishness. The small upper shadow represents bearishness in the market. So this is the reason why the hammer is called as a bullish pattern, because if you look at the psychology of this candle, the bulls have won the battle. Even if it's a black candle or a black real body, still I would say the bulls have won the battle from the bears because of the lower shadow. Because the lower shadow is so long, it indicates that it's the bulls who took control of the market by the time the day was closed. Because even if it is a black candle, it is still closing and near the upper end of the trading range. So that is why the psychology of the hammer is the bulls. Bulls have taken control of the market during that session. Let's look at an example. So in this case, the market was flat here, but a small downtrend started. You have 5 consecutive black candles and suddenly you have a hammer. So let's say there are bears here who have taken short positions and the market has started to come down, and suddenly on this candle, what do you think? Whether the bears are happy or whether the bears are comfortable? Of course, the bears are not comfortable here because of the long lower shadow. If this candle would have closed here somewhere, then the bears would have been very happy and very comfortable. But here, although it's a black candle, the bears are happy, they are still in profit, but there is uneasiness in the market. They are uncomfortable because the bulls have taken control here by creating a long lower shadow. So the bulls have signaled their presence at this price point, which is 130 level. So that is making the bears nervous. So if I were to take a bullish position here, a long position here, and probably I will keep the stop loss under this because I know that the bulls are sitting here and I can aim for this target. So this would be the reward. This would be the risk. So it's a fairly nice reward to risk trade, maybe 1.5 to 2:1. Not a great reward to risk, but still okay. It's an okay trade. This is a daily time frame. It's an ONGC chart. See, it has taken out the R1. There was a doji here representing some resistance here. But you understand what is the hammer psychology now. The market is going down. The bears are happy and suddenly you have a hammer which makes the bears nervous and which makes the bulls stronger and more confident to push the price up to take out the prior resistance levels. Okay? Alright, now let's have a look at the strength of a hammer. So we have discussed the conditions of a hammer before. So let me ask you, if you see these two hammers, which one do you think is more stronger? Of course, the white real body is more stronger than the black real body. Assume that all of them are coming after a downtrend. So there is no question of what is the prior trend here. A hammer itself means that it is coming after a downtrend. So between these two, if I were to choose the more bullish hammer, it would be this. What do you think? What about this? Of course, it could be this because of the white real body. The bulls were more successful than they were here. Yes, here also the bulls were successful, but not as much as they were here. And finally, if you have to compare these two, of course, I will give this one a tick mark because there is still some bearishness here. Although it is small, but it is still bearish, that upper shadow. I don't like that upper shadow. For a hammer, I would like to be, this would be the classic hammer because it doesn't have an upper shadow. It has a small real body at the upper end of the trading range and it is the strongest of all the hammers. Okay, so let's have a look at an example quickly. This is almost a classic hammer. However, one thing I want you to notice here is the trading range itself. In this case, the trading range is very long. The trading range is nothing but the distance between the high and the low. So this trading range is a long trading range. Here, if we look at the trading range, it's a small trading range. Nevertheless, it's a hammer. If we look at the lower shadow, it is equal to or more than twice the height of the real body. So it's a downtrend. It's a daily time frame chart of Maruti. It's a hammer, and although it looks like a classic hammer, but I am not much comfortable with the trading range. The range should be a bit larger. It cannot be this small. But nevertheless, it satisfies all the conditions of a hammer. So I would consider that as a hammer, which is why I have drawn a support line here. So if I were to buy here, I would put my stop loss here and aim for the market to go up, and hopefully it will reach this R1 line. Okay. So that's the reward to risk ratio. That is the reward and this is the risk. And it has reached there. This will be one candle gives you the indication as to what might be coming next. This black candle tried to break the support but could not close below the low of the hammer, and our stop loss was below this. Okay. So a very strong hammer, although I would have liked this shadow to be a bit larger than what it is. So if this shadow would have been like this, I would have been more comfortable with the trade. So that's about the strength of a hammer. After a long downtrend, the bulls show their strength finally on this candle and push the price up. The strength, the shift in psychology starts on this candle. Okay. Alright, now let's have a look at something called as a special hammer. Now in this candle, you can see that the hammer does not have a real body. But that's okay. We have already discussed that the body of the hammer, the smaller the body, the better. Okay. And this also has another name. This is called as a dragonfly doji. It looks like a dragonfly. And the reason why it is called as a doji is because the open and close are the same. Now, the only difference between this kind of hammer and the previous hammers was this does not have a real body. It's a straight line. But if you look at the psychology of what's happening on this candle, the market opens here, then the bears push the price down up until the low, and then the bulls push it back up at the closing point, which was the same as the open. So it's an even more powerful bullish sign. That is why I call it a special hammer. It is a hammer because it satisfies all the conditions of a hammer, which are, first is it must come after a downtrend. It must have a long lower shadow, at least twice the height of the real body. In this case, there is no real body. And the real body must come near the upper end of the trading range, which is available here. Okay. So that's the special hammer. This is the name. Other name for this is the dragonfly doji. Okay. A doji candle is a candle which has the same open and close. So let's have a look at an example of the special hammer. Now, this is a 1 minute chart of Canada Bank intraday chart. The market is coming down and suddenly you have the dragonfly doji or the special hammer. So I have drawn a purple line here. This is our support. If we take a long position here, we can aim for the market to go up and target this resistance. So I would say this would be R1. So till here the bears are happy, and suddenly you have this long lower shadow which indicates bullishness. And one candle pattern, just single candle pattern, predicts what is going to happen in the future. Now, if this hammer candle confirms a prior support area, it's even better, it's even more powerful. So that would be the risk. That would be the reward. It's a nice reward to risk trade. My coach Steve Nissen says that if the reward to risk is 2:1, it's a good trade. If it is more than 2:1, it's even better. So, but the minimum should be 2:1. So in my trading, I use a minimum reward to risk ratio of 2:1. So in this case, we are expecting the price to go up. The hammer is coming after a downtrend, long lower shadow, at least twice the height of the real body, low risk. We keep the stop loss below the support line, take a long position here, and keep our target here. Okay? That is what happens. So the market ascended from that candle. It hit the profit target on this long white candle. That was a nice place to take an exit. In fact, this was a place to take an exit. Another doji, open and close are the same. And the long upper shadow represents bearishness. So this candle is probably the best time to make an exit from the long position that was taken here. Okay? Alright, now let's have a look at the non-hammers. We also must have the skill to identify patterns which look like hammers but which are not hammers. Otherwise, we would be wrong in our trading. If we look at all of these candles, the lower shadow is not more than twice the height of the real body. Here it's a doji and both the upper shadow and the lower shadow are the same. In both of these candles, the lower shadow is not long enough to justify that it is a hammer. Okay? These two candles do not have an upper shadow. However, the lower shadow is not large enough to say that this is a hammer. If this shadow would have been like this, then I would say it would qualify as a hammer, provided it comes after a downtrend. Okay? So these are non-hammers. These are candles which are not hammers. So if you see this kind of candle after a prolonged downtrend, please do not mistake them for a hammer and take a long position. So for example, this is the daily chart of Hindustan Unilever. So the market is coming down from the second week of March. So now we are in the first week of April. The market is coming down. Look at this candle. The lower shadow is not long enough to say that this is a hammer because the lower shadow, the height of the lower shadow is almost equal to the height of the real body. So that is why it is not a hammer. So if people think that this looks like a hammer, so let's take a long position here. That's not the correct way to trade. For a hammer, the lower shadow must be at least twice the height of the real body. It should look like this, not like this. Now in hindsight, if we see this trade has worked out, anybody who would have taken a long position here would have made money, but you don't know what is going to happen next. Chances are the price might go down as well. So we need to trade when the pattern is correct. I would not take a long position here because it is not a hammer. Although it is coming after a downtrend, it has very low, very small upper shadow and quite a good lower shadow. But the lower shadow is not long enough to say that this is a hammer. So I would not take this long position. Okay. Alright, now let's have a look at an interesting scenario. Avoiding the hammer trap. Now, what do I mean by avoiding the hammer trap? Now, you look at this candle. It looks like a hammer but it is not a hammer because it is coming after an uptrend. Remember, one of the main criteria of any candlestick pattern is also the prior trend after which the candlestick appears. My coach Steve Nissen says that it's not just the pattern that is important, it is also the prior trend that is equally important. So we have said that the hammer should always come after a downtrend. So this hammer, if it is coming after a downtrend, then it is called a hammer. But since here it is coming after an uptrend as pointed by this black arrow, it is not a hammer. It looks like a hammer, but we cannot call it a hammer because the position at which it is appearing on the chart is incorrect. So this is where the importance of correct knowledge comes in. If we have half knowledge saying that, okay, this candle looks like a hammer, so it is a hammer, and we take a long position, chances are you will lose money because the price may start coming down from there because you have an uptrend, and after this candle the market starts falling. So we need to have complete knowledge of how to use a hammer. The prior trend is as important as the candlestick itself. It has everything else is lining up to be a hammer. The long lower shadow, the small real body, upper end of the trading range, everything is okay, but the trend is not okay. So we need to avoid scenarios where the hammer-like pattern look comes after an uptrend, and we should not take a long position in such scenarios. So look at this example. This is the daily chart of Sun Pharma, a nice uptrend. And suddenly you have a hammer-like candle. Now, those who do not have proper knowledge of a hammer would say, okay, this looks like a hammer, so let's take a long position and go in the upward direction because the price is likely to go up. But if you have correct knowledge, you say that, okay, this looks like a hammer, but it's not a hammer because a hammer should come after a downtrend. It should not come after an uptrend. So if you would have taken a long position here, see, you would have lost money. So it's important to know where the candle is appearing. It should come after a downtrend, okay? If it is coming after an uptrend, it is not a hammer, okay? Alright, now let's have a look at the power of a hammer. A hammer is an extremely powerful bullish sign. So let's look at an example of how powerful a hammer can be. So this is a chart, this is a daily chart of NMDC. So we are looking at the power of a hammer. Let me grab my pointer. Okay. So now in November, third or fourth week, a nice downtrend started. Okay. The price has been falling, although it has been fluctuating in between, but in general, it has been falling down. So now after this downtrend, you have the hammer, okay? It is called as a hammer because the lower shadow is at least twice the height of the real body. So, which is a bullish sign. So this is the first signal, which is the hammer itself. Second thing, you notice that this is support area because this is where the price turned. And this is another support area where the price has turned, okay? So let's call this S1. Let's call this S2. Now, if we look at this hammer, the hammer intraday, it tried to close below S1 or S2, but by the time the session ended, it failed to close below either S1 or S2, which is an even more bullish sign. When the bears try to push the price below the prior established support lines and they fail to do that, it means what? It means the bulls have overpowered the bears completely and the bulls have not allowed the bears to close the price below S1 and S2. That's the psychology going on here. So that's the power of a hammer. The hammer indicates the power of bulls. So if I were to take a long position here because the hammer is confirming prior established support areas. So if I were to take a long position here and I keep my stop loss under the low of the hammer, I can aim for these highs here because we know that the bears are sitting here, or I can aim for these highs here. This is where the bears are sitting because that's where the price turned. And I can aim for the price to go up. Okay? In this case, the price went up aggressively. That's the power of a hammer. That is why I took this chart. After this hammer, suddenly there was this gap up, which is called as a window in Japanese candlesticks terminology. It has taken out this, it has reached this target. It has also reached this target on this candle. Okay? So, understand that a hammer confirming prior support area especially is a very powerful bullish sign. The hammer is extremely bullish. Single candlestick pattern, simple to understand, easy to apply. It gives us a clear entry point. It gives us a clear stop loss. One thing to understand is that the candlestick patterns do not give us price targets. Okay? So that is why we take these levels. Right. Now let's have a look at hammer as a support. Now we mentioned when we discussed the definition of hammer is that a hammer becomes support. The low of the hammer often becomes support. So this is how a hammer looks like. Long lower shadow, twice the height of the real body. The low of the hammer becomes support. So I would keep my stop loss below the low of the hammer because I know that this is where the bulls are coming back into the market. So if the price reaches here, maybe the bulls will push it back up again. And the hammer is coming after a downtrend. So my stop loss will be here. My entry point would be the close of the hammer. If it's a white candle, it would be here. If it's a black candle, it would be here. And then I look for the price to go up from there. Okay? So let's take a look at an example. So now in this example, we'll look at how the hammer becomes support. So this is a daily chart of Maruti Suzuki. The price is following. It's more than 7-8 candles, consecutive black candles. The hammer itself is a black candle. However, if we look at the long lower shadow, more than twice the height of the real body, nice downtrend, all the criteria of a hammer are satisfied. So I draw a purple dotted line here below the low of the hammer, which indicates that this is our support line. So we need to see whether the low of the hammer becomes support or not. See, for a long period, the price remained or got stuck in this range. This one and the purple dotted line, but there is not a single candle in so many days. From November 3rd week till about January 2nd week is a long period of time where the hammer support was held or the hammer support was respected. None of these candles have been able to close below the support created by the hammer, which means that the support of the hammer is very strong. The low of the hammer often becomes support. And eventually once this box range, this is what is called, the Japanese called as box range, where the price is stuck in a box. Once this box range was broken, then it started to pick up. The bulls took control of the market and took the market up. But nonetheless, the objective of this chart is to show you that the hammer support is very strong. We can be rest assured if we keep our stop loss below the low of the hammer, chances are very low that our stop loss will get hit. Okay? Alright, I wanted to show you this chart because it talks volumes about the power of a hammer. So this is a monthly chart. I like to look at long time frame charts because the longer the time frame, the more is the predictive power of the candlestick pattern. So this is ACC monthly chart. So you have a nice downtrend. Remember, every candle represents 1 month worth of price action. So this is in the month of June, you have the hammer. Now this is a very significant candlestick pattern on a monthly chart because during the month, the price opened here. During the entire month, the bears were trying to push the price down. They were successful in doing that. But by the time the month closed, the bulls were successful in pushing the price back up to this closing point, which created a hammer-like pattern. And this is a hammer because it's a small real body near the upper end of the trading range. Long lower shadow, at least twice the height of the real body. And it is coming after a nice downtrend, and that too a downtrend on a monthly chart. So very, very significant candlestick pattern. This represents the battle of bulls and bears during the entire month. It is not a 5-minute candle or a daily candle. So that is one signal. Second signal, and the most powerful, is look at this support line. created by this, because this is where the market has turned. So this was the low of the downtrend which started here, which came in October or November of 2016. This is where 2017 starts. The hammer has respected this support line. So this is where the bulls come back to the market, and after so many years, like this was in 2016, this is in 2018, second half of 2018. So after almost 2 years, the bulls are still sitting at that location, which corresponds with 1250, which is also a round number. Round number is a number which ends at 1200 or 1250, things like that. So it's a round number in an important turning point, because last time also the price has reversed at this particular point. So 1250 is an important level, and at exactly that level we have a reversal here, and after 2 years again at exactly the same point we have a reversal. So the market has its own memory. So a candlestick pattern appearing at a very important turning point which came earlier and is also coming now. So if we were to take a long position here, we would keep our stop loss under the low of the hammer. Under the low of the hammer here, so that would be our risk. And candlesticks do not give us the price target, so we would aim for this is the shooting star. We have not covered shooting star yet, but this is the resistance area. So we can aim for the price to go up until this resistance area. That would be our target. So nice reward to risk trade. Understand that this is a monthly chart, so this trade will take some time to materialize. So you may have to wait for many months for the target to reach. But very important candlestick pattern appearing on a monthly chart, okay? So it did not reach this resistance area, but it was close. However, there was no need to wait these many months. These two candlestick patterns were enough for you to book your profits. So if you would have taken, if you had taken a stop loss here, then these two candles itself from 1250, it has gone almost to 1600 level. That was a good profit in 2 months itself. There was no need to wait for the third candle. These two candles itself has given you a nice profit. So all of this happening on a monthly chart, okay? Okay, as discussed, we keep the entry of the hammer at the close of the hammer. So for a white hammer, this is our entry point. For a black candle hammer, this is our entry point, and we keep our stop loss just under the low of the hammer. So we have a clearly defined risk level. So that's our entry and that's our stop loss. Let's have a look at an example. So this is very important to keep a stop loss, and I'm going to show you an example where our stop loss gets hit. We have looked at examples where our stop loss did not get hit, but now we are looking at an example where our stop loss gets hit. So this is an intraday chart of Ambuja Cement, 30-minute chart. The price is coming down. This is a classic hammer. Even on a classic hammer, there is a good chance that the stop loss might get hit. That is why, as professional traders, we need to always trade with a stop loss. We should never trade without a stop loss. So I would keep my stop loss just under this line. That would be my entry point. That would be my risk. And I would aim at these highs here as my profit target, which is a poor reward to risk trade. It is not 2:1. But nevertheless, this is a clearly defined classic hammer. And we have to keep a stop loss. That is our entry point. That is our stop loss, and that is our profit target. So this is an example of a standalone hammer that did not work well. The reason why I call this a standalone hammer is because it is not confirming any prior support area. If it is confirming a prior support area, it adds more confirmation to the hammer trade. So that is the reason why this is a risky trade. Conservative traders won't take this trade. Aggressive traders would go long on this and try to shoot for this resistance area. So in this case, this hammer did not work. So it was important to keep our stop loss here. If we had not kept our stop loss here, then our losses would have multiplied and our position would have remained in loss for a long period of time. Although this is an intraday chart, but we would have been out here and we would have got back our capital. Our capital would not have been stuck in the market for a long time as it happened here. We would have quickly got out of the trade because of our stop loss. So it's very important to trade with a stop loss, irrespective of whether it's a normal hammer or a classic hammer or whatever. As professional traders, it is by rule we have to trade with the stop loss, no matter how powerful the candlestick pattern, okay? So I wanted to show you this trade, that there are trades that will work and there are trades that will not work. It doesn't matter what the loss is. What's important is when you are making profits, what is the size of those profits? And when you are making losses, what is the size of your losses? Profits should be huge and profits should more than compensate for the small multiple losses, okay? Right, now let's look at how do we set up profit targets when we are trading the hammer, okay? So this is a chart of Hero Moto. It's a weekly chart. Remember I mentioned multiple times that the bigger the time frame, the more is the probability that the trade will work out in our favor. So in this case, you have a nice downtrend as pointed by the blue arrow. You have a reversal here, an N shape. The market is coming down. Each candle represents 1 week's worth of price action. So I have drawn 3 purple dotted lines here. So we have a hammer here. This is not a classic hammer because we have an upper shadow. So, but the lower shadow is at least twice the height of the real body. That is why I call this as a hammer. We know that the low of the hammer becomes support, so I keep the stop loss under the low of the hammer. We take the entry at the close of the hammer, so this is our risk. And where do you keep the reward? Remember, candlesticks are a tool, not a trading system. Candlesticks do not give price targets, so that is why we need to use Western indicators like support and resistance to come up with profit targets. So since this was where the previous reversal happened, I would say this is a previous high, so we can aim for the previous high. So that would be our profit target. So long position, stop loss and a profit target. Let me reiterate, this is a weekly chart. So this candle represents entire week's worth of price action, which means that this candle represents the fight between the bulls and the bears for the entire week. It is not just for a day, okay? So it took 1 week for the bulls to prove that they are in charge of the market finally. Because if you see how many candles are here, 1, 2, 3, 4, 5, 6, 7. After 7 consecutive bearish candles, you finally have a bull candle, and that too a candlestick pattern which is a hammer, and that too on a higher time frame which is weekly chart. So all of these factors significantly improve the probability that the trade will work out in our favor. So that's how I look at this trade. So in this case, our target was met by this candle. Although this candle did not close above the profit target, however, it touched our profit target and we booked our profits there. Notice that it has taken a long time for that target to be achieved compared to what compared to the time that it took for the price to come down from here to here. So as traders, we really need to have that patience for the price to go and hit our profit target. However, in this case, if I would have been trading, I would have probably got out at this pattern, because this is a bearish engulfing pattern which we haven't discussed yet. However, a long black candle completely engulfing a prior small white candle indicates a shift in psychology. So I would have probably got out there. I would not have waited. I would have taken this much profit. Okay. So as we learn more and more candle patterns, we will also learn where exactly to exit. We don't have to wait till this point to make our exit. Okay. So that is how we set profit targets with the hammer. Alright, now let us have a look at how we can use the hammer and set our reward to risk on a trade. As mentioned before, I do not take a trade if the reward to risk on that trade is less than 2:1. Preferably it should be 2.5:1, but 2:1 is also okay. So in this chart, we will look at how to set reward to risk with a hammer. This is a weekly chart of Titan. Again, the bigger the time frame, the higher is the probability that the trade will work out in our favor, because one candle contains 1 week's worth of price action. One candle represents 1 week's worth of battle between the bulls and the bears. So in this case, you see a nice downtrend pointed by the blue arrow. Then you have a hammer coming after a downtrend. So that's our entry point. The low of the hammer is our support. That's our stop loss. So that's the risk. And we aim for the previous high, which was this. So that is our profit target. So we have a nice reward to risk here of more than 2:1 easily. I would say it would be 3:1. More than that. So it's a nice reward to risk trade which we can aim at. Another thing I want to highlight here is the gap between these two candles. So if I draw a line here and I draw a line here, there is a gap. There is no price action. So this kind of a gap is called as a window in Japanese candlesticks terminology. It is also called as a gap in Western technical analysis. A gap is where there is a price vacuum, or a gap is where there is no price action at all. So a rising gap or a rising window becomes a very strong support in Japanese candlesticks terminology. So if I draw this line here, see, this candle entered the window, but it could not close below that window. So windows we will cover later, but please understand for this chart that any gap, a rising gap becomes a support area and a falling gap becomes a resistance area. So in this case, the hammer which we are looking at is confirming the support area created by this rising window. So that is why this hammer becomes even more important. So not only is it a candlestick pattern, which in itself is a bullish sign, but it is also confirming a prior established support area, which was the window's support area. So that gives us that extra confidence to trade. Plus, we have that reward to risk ratio in our favor. So anything which is about 2 or 2.5:1, I am comfortable taking that trade. So that is how we look at this chart and see it has hit the profit target. This was the candle that hit the profit target. On this candle, we just missed it. But good trade, good setup. If we look at the overall market picture, we get a whole sense of how to trade the hammer. Okay, with a good reward to risk ratio. Alright, now let us have a look at how we can trade the hammer aggressively. A trade on a standalone hammer is a risky trade. Remember, we looked at an example of how to keep a stop loss, because as professional traders, we need to be able to cut our losses. So we have looked at a standalone hammer before. A standalone hammer is a hammer where it is not confirming any prior support area. So a standalone hammer is always a risky trade because we don't know whether any bulls existed previously at that price point. So let us have a look at the hammer, a standalone hammer. The reason why I call this aggressive trading is because it is not confirming any prior support. We don't know what is going to happen next, which is why it is important to keep a stop loss on these kinds of trades. So an example will help you understand better. So a nice uptrend here, then the downtrend as represented by the blue arrow. This is a daily chart of Petronet. It's a standalone hammer. So this is our hammer on the daily chart. Now the reason why I call this as a standalone hammer is because it does not confirm any prior support area. If there is a price action here, the price comes here and bounces back here, then we have a support area. And then if the hammer confirms that support area by failing to close below that support area, then that is what I call as a hammer which is confirming a prior support area. That is not a hammer which is called as a standalone hammer. In this case, this is a standalone hammer clearly because we don't know what is going to happen next. The price may even go and fall down. Okay? So as an aggressive trader, I would take this trade. As a conservative trader, I would wait till there is some other pattern here which confirms the support established by the low of the hammer. Remember, the low of the hammer always becomes support, or the chances of the low of the hammer becoming support are very high. So if we take an entry here as an aggressive trader, we should keep our stop loss below the low of the hammer. And then we should aim for the nearest or the previous high. So it's a nice reward to risk trade. However, it's a risky trade. Do not take this trade without putting a stop loss. If the price goes below and closes under the low of the hammer, that means the bullish implication is negated. So in this case, we aim for the price to go up. Okay, that is why I call this as a standalone hammer. In this case, the trade worked out in our favor. Our stop loss was not hit for many days. This is where our stop loss was hit, but by that time, we would have made a lot of profit. Okay, so standalone hammer is a risky trade. However, as an aggressive trader, I can go for this kind of trade, albeit with a minor position. If I want to buy, say, 100 shares on a normal trade, I would buy only 25 or 30 shares on this kind of a trade situation where we don't have prior confirmation. The market as well might go down from here. So I'm comfortable with a hammer which is confirming prior support. I am not comfortable with a hammer which is a standalone hammer. Okay? Alright, now in the previous video we looked at how we can trade a standalone hammer. That is what I call as an aggressive trade. But what if a hammer is confirming a prior support area? We also need to look at an example of that. So a hammer confirming prior support is a very bullish sign. And obviously so, because the bulls have proven that at that price point, they come back into the market. And if we have a hammer at that particular price point, then it becomes an even more bullish sign than the standalone hammer. Okay? So let's have a look at an example that will help you understand clearly what happens when a hammer confirms prior support. So I have taken a weekly chart of Infosys. I always look at higher time frame charts because bigger the time frame, the more is the probability that the trade will work out in our favor. So this is a very interesting chart because if you see here, I have drawn a purple dotted line. None of these candles have tried to break, have been able to break the purple dotted line, which is the 450 level. Again, there were two candles which tried to test that line, could not close below that. Again, there was an attempt by the bears to push the price below 450, again a failure, and again now fourth time you have a classic hammer. The reason why this is a classic hammer is because it does not have an upper shadow. The lower shadow is more than twice the height of the real body. It is coming after a very long downtrend, which is represented by the blue arrow. So this hammer is confirming a well-established support area. We know that whenever the price comes to 450, the bulls come back into the market, okay? So this hammer tried to break during that week. The bears tried to break that support level, but were not successful in doing so. So the bulls, bears tried to break that support level but could not do so. In other words, the bulls have established the fact that they are still dominating the market and they will not allow the price to go below 450. So if we take an entry here and we keep our stop loss under the low of the hammer, that becomes our risk. Now to set the profit target, we can aim for this level, because this is where you see bears coming into the market. They are not allowing the price to go beyond that. In fact, 500 would be a level because none of these candles have been able to close above 500. So this would be R1, this is resistance 1. This would be R2, that is the resistance 2. And you have then this line and this line. This is the resistance zone. This entire zone that you see, this entire zone is the resistance zone. This is where if the price comes in this zone, it makes sense to exit the long position that we have taken here. Because we don't know whether the price will be able to cross this zone, because it will take a lot of power from the bulls to cross all of these 4 levels. Okay, so if at all you are taking a trade here, you have to become cautious once the price starts entering this zone. Okay, and remember again, let me reiterate, this is a weekly chart of Infosys. Every candle represents 1 week's worth of price action. So these 3 candles was 3 weeks. So for 21 days, the price was trying to break that 450 level, couldn't do so. 15 days again they tried, couldn't do so. Again 21 days they tried, couldn't do so. Again for 15 days, because we also have to look at this long black candle. It poked below the 450 level but could not close below that. That itself was a very positive sign. And the hammer itself gave the bullish confirmation that no, that level still holds as support. So it makes sense to take a long position now after so many confirmations. Contrast this with the previous video where we looked at a standalone hammer which is not confirming anything. So that is why the hammer this kind of hammer becomes a very bullish sign. So what happens when a hammer confirms support? The price is likely to go up like this. So in this case, our stop loss was never hit, and look at the price action. Although it took a lot of weeks for the price to go, but it has broken every kind of resistance level which we have looked at. Okay. Alright, before we look at how to trade the hammer ultra conservatively, I want to quickly take you back to that concept of a standalone hammer, which is a risky trade. A standalone hammer is a bullish sign, but a low probability bullish sign. In the previous video, we looked at an example where the hammer was confirming prior support area on a weekly chart, which gave us that additional confirmation that the hammer is a potential very strong bullish sign. But a standalone hammer I am uncomfortable with, because we don't know what happened at that price point previously on that chart. So let us quickly have an example before we move to the next chart in this video. So this is a standalone hammer that worked well. We have looked at two examples before. One is a standalone hammer that did not work well and it went on to hit our stop loss. Another was a standalone hammer that worked well. So this is a standalone hammer that has worked well, another example. But this is again a risky trade. The one factor that reduces risk in this trade is the time frame, okay, which is the weekly time frame. I have been reiterating in this course that the higher the time frame, the more is the information that is contained in that candle, and it gives that added confirmation that it might work, the trade might work in our favor. Another factor that reduces risk in this trade is the fact that this is a classic hammer. There is no upper shadow and the lower shadow is at least twice the height of the real body, all coming after a downtrend. And it's a weekly chart. So although it's a standalone hammer, but there are a couple of factors like these which are giving me the confidence that yes, the market is likely to push up from above this level. So there is no hard and fast rule that says that you don't have to trade the standalone hammer or you have to be an aggressive trader to trade the standalone hammer. Depends on the market context. It also depends on the time frame that you're looking at. In this case, I would be comfortable taking the trade, although with a minor position because it's a standalone hammer. Because it's a classic hammer and it appears on a higher time frame. So this candle is representing entire week's worth of battle between the bears and the bulls. So that gives me that additional confirmation to hit for the trade to go up. Okay. So in this case, the trade has worked out, but I would definitely keep a stop loss in any given case to protect my position. Okay. So now, as mentioned in the video, that we will look at a hammer with price confirmation. So to avoid situations like this where you don't know what is going to happen next, we look at something called as price confirmation. So the hammer confirming price, confirming prior support, and giving price confirmation is a high probability trade setup, although it comes at the cost of reward to risk. So let me explain what is happening here. First is the hammer confirming prior support. So we already looked at this example of that weekly chart of Infosys where the hammer was confirming prior support which was tested more than 3 times. And then after the hammer, the price went up. Okay. Then there is something called as price confirmation, which means that once you have that hammer, you don't take a bullish position here. You wait for the next candle to close. Depending on where the next candle closes, you decide whether you want to take the trade or not. So if the next candle closes above the close of the hammer, that is what we call as price confirmation. I learned this technique from my coach, Steve Nissen. The price confirmation gives us the additional confirmation that our bullish view is correct and we can expect the prices to go up. However, when I am looking to buy at a price higher than the close of the hammer, it means that I am buying at a higher price than what I would pay for if I bought at the close of the hammer. So my risk is increasing. So if my risk is increasing, my reward to risk is decreasing. Okay, so that is a trade-off that we have to beat. So if we are trying to increase the probability of our trade working out, then we have to sacrifice on the reward to risk. So it is a trade-off. So let's look at an example. Again, I have taken a weekly chart here. We are looking at a hammer with price confirmation. So now you have a hammer here. This would also be a hammer, but the upper shadow gives me some discomfort. This is a nice hammer with a good larger trading range than this hammer. So it's coming after a downtrend. Remember, it's a weekly chart, so higher time frame. So the argument here is, rather than taking a long position here and keeping a stop loss here, why not wait for one more week, take the trade at the closing of this candle, because it has closed above the close of the hammer, and then increase our risk, but we are also increasing the probability that our trade will work out, and then take the trade. So in this case, our strategy has worked out, because if we would have taken a trade here, probably the price might have gone down, but this close above the hammer gave us that extra confirmation that the price is likely to go up. So we can use that extra confirmation of price to increase our probability, but for that we have to sacrifice on our reward to risk. Okay, so that is called as ultra conservative trading. So that is another technique which we can use to increase the probability of success. Okay. Alright, now let's have a look at a quick summary of what we have been discussing till now. We must know how to trade the hammer correctly. So first we spoke about a standalone hammer, and in any case we have to keep a stop loss. So we spoke about a standalone hammer which has a low probability of working out. However, if it comes on a higher time frame, I may take the trade, and even if I take the trade, my position is likely to be a small position, not a major position. Next, we looked at the hammer which is confirming prior support, the weekly chart of Infosys that we saw. So if the hammer is confirming a prior support area, it means that it is respecting the bull's price action at that level which happened before. So that increases the probability of our trade. And one step further, we can either go for hammer plus price confirmation or all the three. So in this case, as we have discussed, the probability of our trade working out is increasing. However, the reward to risk is going down. Okay. So if we are willing to sacrifice that reward to risk, we can wait for that extra price confirmation, which means that we wait for one more candle after the hammer to see whether our bullish view is correct or not. So that is how the hammer must be traded. There are many other ways to trade the hammer, like combining the hammer with multiple Western indicators like Bollinger Bands and stochastics and RSI and things like that. People combine candlesticks with Western indicators, but this is the basic way of trading the hammer. At least if you are a beginner, this is where you get your start. The hammer gives you a bullish signal. The question is whether you take that trade or not. So these are ways to increase the probability of that trade working out. Let's quickly look at another example of a hammer. This is the second part where I am having support confirmation. So this is a hammer on the daily chart of Ashok Leyland. So this hammer is confirming prior support area established by this previous low. Look at the precision of candlesticks. Exactly at that price point, the hammer is created. And although it's a nice looking hammer, but look at the trend here. It is a hammer because it's a downtrend. And as discussed while we defined hammer is that even if it's a short-term downtrend, that is still fine. It is still a hammer. I would not be too confident on this because the trend is not very defined. It looks like a flat market. Okay, this is the only candle which says that, okay, we can call it a downtrend, but I would be uncomfortable taking this trade. That is one factor that is negative here. But the one factor that is positive here is this low. After such a long downtrend, you have this nice established low point because it's coming after so many days. remember it's a daily time frame, so one candle represents 1 day's worth of price action. So that's an important level which is confirmed by the hammer here. So the one negative is the undefined downtrend and the one positive is the prior support confirmation. So it is up to your discretion whether you want to take this trade or not. If I were there, probably I would not take this trade. Even if I were to take this trade, I would take a small position, not a major position. Okay? So this was an example of hammer confirming prior support. In this case, the trade has worked out fine. However, I would be uncomfortable taking that trade considering the fact that there is a resistance here also. Okay? So to quickly summarize, the more confirmations we need, the more is the probability of the trade working out, but at the expense of reward to risk ratio. Remember, the reward to risk ratio is a common theme that is going to run across my all training programs from here, because that is the most important concept in trading. It is not about getting every trade right. It is about booking more profits when your trade hits the profit target and booking less losses when your trade hits the stop loss. So the profits should more than compensate for the small losses. So that is why we are looking for more and more confirmations like this. Okay? Alright, now let's have a look at a quiz question. This is an intraday chart of HDFC. This is the 1 minute chart. Remember the rule that candlesticks are universal. Irrespective of what time frame you are trading, the candlesticks can be applied to any time frame. The candlesticks can be applied to any asset class, whether it is stocks, commodities, currencies. The candlesticks can be applied to any instrument, for example, options, futures, spot positions, whatever. So the candlesticks have this universality. So in this case, we are looking at the chart of HDFC 1 minute. The question is, which trade would you take and why? So let's say you have these two hammers. And which hammer do you think is a better trade to take? Okay, now in this case, you can see what happened after this hammer, but assuming you don't have these candles, would you take this trade? And here you don't know what is going to happen next. So if given an option between these two hammers, which trade would you take and why? Okay, so pause the video and think about it, come back to it. Okay. Let us analyze this chart. This is very interesting. Okay, so you have a nice downtrend. You have a hammer which is a classic hammer. Compare these two hammers. This is a classic hammer. This is a normal hammer because it has an upper shadow. This doesn't have an upper shadow. Both of the hammers are coming after downtrends. But there is a main difference between these two hammers. This is a standalone hammer. Okay, it is not confirming any prior established support area. So although it's a classic hammer, but I would be uncomfortable taking this trade because there is no prior support confirmation. But if I look at this hammer, it is confirming the support created by this hammer. Okay, so we know that the low of the hammer becomes support. So if I draw this line, see, now we have an established support area. And this hammer, although it is not a classic hammer, but it has still tested and has failed to close below the support created by the prior hammer, which means that this hammer has respected the support created by this hammer, which is a very important point. So we have been discussing for a long time now the difference between standalone hammer and the hammer which confirms prior support area. So I would be comfortable taking this trade. I would not be comfortable taking this trade. Even if I take this trade because of the classic hammer, I would take a small position. And If I take a trade here at this, that would be my entry point. Under the low of the hammer, I would keep the stop loss. I wouldn't keep the stop loss until this because it was broken already. So that would be my risk, and I would aim for these highs because this is where the price has turned. So I expect the price to go up. So it's a nice reward to risk trade as well. So I will be comfortable with a hammer confirming prior support, even if it is not a classic hammer. Okay? So in this case, the trade has worked out fine. It has taken out this R1 level. Okay, that is a resistance 1. Second profit target would have been this level, which is R2. Even that level was taken out by the bulls. So this hammer was more powerful than this hammer. After this hammer, there were only 2 bullish candles. But after this hammer, you have a nice uptrend starting. This is an intraday chart, HDFC. Okay? Alright, now let's have a look at another quiz question. So let me give you some hints here. Okay, this is Coal India. It's a daily chart. Would you take this trade and why? If yes, then why would you take this trade? And if no, why would you take this trade? So this is a hammer. It's a classic hammer. The question is whether it is a hammer in the first place. Okay, that is my first hint. Second hint is you see this box range, the price is stuck in this range. Okay. So those are the 2 hints that I have given to you. Think about it, pause the video and let me know whether you would take this trade. If yes, then why would you take this trade? And if no, why would you not take this trade? If you would take this trade, then where would you keep your stop loss? Where would be your entry point? What would be the position? Whether it would be a long position or whether it would be a short position. So pause the video, think about it, okay? Alright, now the question here is our basic assumption itself. It looks like a hammer, but it is not a hammer. Why? Because it is not coming after a downtrend. Although we can say that from here to here it was a downtrend, but look at this flat price action. This is almost a flat price action. So I want a hammer which comes after a nice, if the price were going from here till here, then I would say it would be a hammer. So we have the very basic assumption we have questioned here whether this is a hammer or not. It looks like a hammer, but it is not a hammer. Okay? Now, if it is not a hammer, there is no question of taking the trade. So my answer to this question would be no. I wouldn't take that trade. If it was a hammer, then I would think about taking the trade if the reward to risk and other factors are in place. But it is not a hammer at all. Even though it looks like a classic hammer and it is very enticing, but it is not a hammer because it is not coming after an uptrend. It's a flat market here. So the chances are the market might remain flat in the future as well, which is what happened. So it took quite a few days for the market to exit this. If we look at this box range, the Japanese call a flat market as a box range. So the price has remained in this range for quite some time now, from March first week to almost April second week. So that's a period of 1.5 months approximately. So the price has remained in this box range for quite a long time. It's a daily chart. And this candle has no significance at all. It looks like a hammer, but it is not a hammer. That is the importance of correct knowledge. Because many people think that it looks like a hammer, so we take a long position. But it is not a hammer at all. Interestingly, if you see the low of this candle, it has worked out well as a support. Although it has worked out well and the price has gone up, but I wouldn't take that risk. The price might even fall and it could have gone below that box range as well. So I wouldn't take that risk. So it's not a hammer. So I would not take this trade, and those are my reasons why I would not take this trade. One note I want to mention before we end this section on the hammer is that before even I take the trade, I should be very clear why I am taking the trade. I should be very clear what is the price that is going to prove that I am wrong. So if the price closes below the low of the hammer, I should be out of the trade because my bullish implication has already been negated. So I should be very clear why I am taking the trade. I should be very clear what is my stop loss. I should be very clear at what price point I'm going to take profits. If all of these parameters are subjective before taking the trade, I would suggest do not take the trade. So calculate your risk before taking the trade. Okay?